Hello, everybody, and welcome to another episode of the Capital Gains Tax Solutions podcast, where we believe high net worth individuals and their professional teams struggle to find great capital gains tax deferral options. Not having a clear plan is the enemy. Using a proven tax deferral strategy is the best way to exit highly appreciated assets, tax deferred, to create, preserve, and grow wealth. I'm your co-host, Pearson York, filling in for Brett Swarts. I'm excited about this guest. Good friend of mine. Met back up at the Best Ever Conference. Fund manager, real estate syndicator, coach. The list is endless. We're gonna let him tell him story. Eddie Austin, how you doing, my friend?
Man, I am doing great. How about you?
I'm doing awesome, man. Super excited. So Eddie, let's hop right into this, man. Usually I like to do like a background and all that kind of
Yeah.
stuff, but we got so much content today that I think we should just hop right into it, and we'll get to the story a little bit later. So
Yeah, absolutely.
the here's the main topic for today, right? The difference between people going into single syndication assets versus funds.
Right.
There's a lot of stuff in the market going on right now. Let's talk about them. Let's define each of them, and then let's go the differences.
Yeah. Let's start with what's going on in the market right now. We've got the banks, we got a run on banks. We got tons of money in the street because of these banks and everything going on right now. And that's more the reason why, anytime there's a problem, we need a solution. Well, that solution, in my opinion, is a real estate fund. Something that kind of looks like a bank, kind of resembles a bank. And because you're going to put money in it, and we're going to go out here and we're going to put that into multiple assets in multifamily. You can do a fund with for multifamily, industrial space, warehouse space. I've even heard people doing funds for cryptocurrencies now.
Sure. So just so we're clear, right? Let's define the difference between a fund and just a single asset syndication.
Sure. Yeah. So the syndication is a single property entity. So if you identify a piece of property, you're going to say you've got a 300 unit Class B property in Dallas, Texas. You've identified that piece of property. You're going to contact your lawyers. You're going to get an op agreement, subscription package, and a PPM, a private placement memorandum. And you're going to have that tied to that single piece of property. You're going to raise money for that asset, and you're going to close one asset. That's it. That's all you can do, is just one asset through a syndication. I kind of call it, kind of like Bridger Pennington calls it, it's a hamster wheel. It's a ton of work.
Sure.
For one piece of property. We're going to just do all this work. We're going to contact our lawyers. It's going to cost us 15, 20 grand. And all that money spent, you've got a ton of risk involved because it's one piece of property. It's not diversified. There's a big responsibility on you, the guy, the sponsor of the deal. And with that, here we go. We're relying on us being able to raise all this equity to close this opportunity. If we
Sure.
don't do that, because we're starting from scratch, then you could lose your relationship with your broker. Being non-diversified, you could have some trouble with your investors. If you're dinged on cash flow and your value add strategy,
Yep.
you're not diversified in multiple assets. So yeah, syndication, it's one piece of property, one address, and one opportunity. Those documents are just for that piece of property, and you're only raising for that piece of property.
Yep. So the difference, just to simplify that, right? Summarize it, is when you're doing a syndication, you're pooling a bunch of people, friends, family, other investors' money together to buy a single asset. Usually it's a bigger asset. You're putting usually 35, 30, maybe 40% equity. The rest of it, you're putting debt.
Yep.
And, your returns are directly correlated, causally correlated with that asset and how well that asset performs. So if that
That is
asset tanks, your investment tanks.
absolutely
Conversely, the fund, right, allows you to diversify because you're putting it in, right? You're getting typically a set return depending upon how the fund is structured, right? An equity fund versus
right.
a debt fund, and so on and so forth, right?
Right.
I think for this particular purpose, we're talking about a debt fund. Am I off there?
No, so you'd be essentially an equity fund. So, for instance, my funds are usually a 8% preferred return. and 70/30 on the waterfall or carried interest to the investor. So we're sitting beside senior debt. So we're raising that money exactly like a syndication. We're raising money to put in the 30 to 45% down. And then we sit next to senior debt, and then all cash flow of the property rolls back in at 8% level, and that 70% lion's share back to my investors.
Sure. So then in the fund world, right, there's two different types of funds then, it sounds like. We
Oh,
have
there's a bunch
equity
of types.
funds. Yeah, for this purposes, right? Just
Yeah.
simplify things, right? We have
Yeah.
equity funds on one side where you actually can take part in ownership of the asset as well. And then you have debt funds where people just loan, basically you put money in and they're getting a set pref, 8%, 9%, 10%, 12%, whatever it is, right? On a pretty, annual incurring basis. Where we met, at Best Ever conference a few years ago and then, reconvened back up a few months ago. One of the companies was basically guaranteeing, just on a debt fund based backed by the good faith of the company and all the other, assets. And so you can have some more security. So funds are a great way because it allows you to diversify between different assets and within the fund so that you're not just tied directly to that one asset.
Correct. So now, however, you're in charge of writing your PPM, your fund narrative. That PPM is the Bible. So if that fund specifies that you're going to invest in North Carolina, South Carolina, Florida, Texas, on those areas, and then you've probably identified you're going to invest in the DFW area, Houston, North Carolina, and Charleston, or you're going to invest in Tampa, Florida. And then you're going to have a buy box. And in that buy box, you're going to have, we're going to invest in 300 to 600 unit count in size. So 300 doors per asset, up to 600 doors. And then we're probably going to spend 50 to $70 million per acquisition. And it's a light value add. So you can't necessarily, structure a fund and then go out and buy a storage unit. You're going to have it structured just for whatever you're going to go buy.
Okay. So correct. So basically, you are saying, hey guys, here's the buy box.
Yep.
Right. Here's the assets we're going after. If they don't fit within our mission, right, you have our word, we're not doing it. And we can't even legally do it. Right? This is that fund. If you want to go start, move from multifamily to self-storage, that's a whole new fund.
Yeah, that's another fund. Absolutely.
Okay.
So here's what happens. There's so many guys that like, well, I don't invest in funds and I don't like funds because it's a blind raise and it's all this stuff. People that do that are just people that don't operate funds well. It's not a blind raise. In your documents, it clearly states that you're looking at this area, you're looking at this city, you're looking at this submarket, and you've got a certain amount of returns. And all that stuff is outlined. And also when you build your pitch decks, when you're actually pitching it to your investors, that's all put together. You've identified a piece of property essentially.
Yeah.
Or at least a buy box.
Yeah, absolutely. So with that, right, let's get into the downside really quick, and we like to give everyone the full truth. So what are one or two, kind of like negatives to a fund versus like a syndication? Where would the downsides be?
So let's start. I'm going to pick on the syndication model. I'm going to outline why I like funds better than syndication. From the top level, syndication, it's one single asset. If you have a heavy value add strategy right out of the gate, you're going to have troubles getting that 8% pref back to your investors because the cash flow is kind of dinged. So you've got that problem. The next problem you have is you have to raise a certain amount of capital in a short period of time. With a fund, you've got 1 year to raise capital and go deploy that. Your lockup time is the same. Lockup time meaning most of the time a syndication you've outlined, you're going to hold an asset for 3 to 5 years. You're going to do the same thing in a fund. And then the other negative to my opinion, to the hamster wheel of a syndication is it's just not scalable. You're going to go spend all of your time raising equity for one single asset. Why wouldn't you build a vehicle to where you could raise a bunch of equity and then deploy that into multiple assets? Now you're diversified. And then if you got one property that's sucking on cash flow, then, your other 2 or 3 in there are still paying your 8% pref.
Sure. Yeah, that makes a ton of sense, right? What are some of the that's a those are the negatives for syndication, right? And some of the
Yep.
reasons why people might want to do a fund. Let's flip it. Why would some people might want to do a syndication over a fund?
So a lot of investors sometimes they say, well, I don't want my money sitting on the sidelines for a year. So
Sure.
essentially you're raising money for a year. So again, it kind of falls back on the operator of the fund, the
Of
manager of
course.
that fund, because if you're an active buyer and you're actively grabbing assets and closing them, your money's not going to be sitting for a year. It's not going to
Right.
happen. So, yeah, there's some downside there. The other downside is they say, well, you have the ability to go buy assets essentially wherever you want, do whatever you want. That's the word on the street.
Sure.
Honestly, again, it falls back to your PPM. If the PPM states we're buying a piece of property in Dallas, we're buying a piece of property in Dallas.
Right. So a lot of it, you know, it sounds like in either case, you're
Yeah,
going to have trust. Trust is the foundation for everything because
you said the right word.
if your
Yep.
operator sucks in either one, you're screwed.
Yeah. It all comes down to everybody asks me, like, Eddie, what do you do about track record? What do you do about this? What do you do about the bank? It all comes down to people know, liking, and trusting you.
You're right.
And it doesn't matter if you do a syndication, don't matter if you do a fund. If you're a good operator and you're good at speaking to your investors to where they know, like, and trust Eddie, it's not a problem.
Right. Yeah, absolutely. Um, let's talk about this idea of people who are investing in the funds.
Mhm.
How do you raise capital for your fund?
Well, so right now, my target is people that's jumping out of these banks. You got the Silicon Valley Bank, they just pretty much went under. There's a lot of people, that bank's gone. There's a lot of people that's took money out of the bank because they're afraid of losing it. So there's a ton of money on the street. So right now I'm looking for retail investors, high net worth investors that have a ton of money that is just sitting dry. It's uninvested capital.
Right.
Matter of fact, Salt Lake City, I went there and there was a gentleman that drove a truck and he was trying to get a motel room. And when he was trying to get that motel room, he said, I don't know what's going on, but everybody here is that all the rooms are booked up. And I said, well, there's probably because there's a big real estate conference going on right now. That's why you can't get a room. He goes, real estate conference? Is that why you're here? I said, yes, sir, it is. Oh, cool. So what do you do? I said, well, I raise private equity through a real estate fund. And then I invest in real estate and not stock bonds and mutual funds. Really? Well, can you explain a little bit more? Yeah, absolutely. So essentially, I take a self-directed IRA, some type of 401k that they have a certain amount of money in that they can direct into an IRA or something like that. Or people that just have a personal high net worth, bunch of money sitting in a savings account, or institutions. But mostly for myself, I like helping the everyday person. So unfortunately, or not unfortunately, but right now our offerings are for accredited investors. So that person needs to be accredited. So if a
Sure.
person has an IRA that they're an accredited person, they can invest in my fund and we go invest that in real estate instead of these stock bonds and mutual fund options. He goes, really? Well, I've got 300 grand sitting in my IRA. I said, you do? Do you have that invested in anything right now? No, I don't. Oh man, you've got to get that in the market. That's just getting kicked around, man. You need to get that into an opportunity that could be invested in real estate. Well, I mean, with a person like yourself, I wouldn't be able to invest in real estate. I mean, I can't, not 300 grand. I said, no, you're completely wrong. Most of my minimums are 100,000, and I have the discretion to drop that down to 50 if I need. So hell, a person with 50 grand could invest with us.
Yeah, that's super awesome because it gives people the ability who maybe don't have millions and millions of dollars to invest inside of and diversify right outside of just the S&P or your ETFs or whatever, right?
Hmm.
Your Wall Street REITs
Right.
essentially.
Yeah.
Something that's interesting, and this is where there's a lot of synergy between what we do, right, and between what you do, Eddie, is I talk to a ton of syndicators, and one of the biggest challenges that they constantly tell me, I always ask them this question, like, hey, like, how much 1031 money do you leave on the table? And they're
Oh
like,
man,
millions, millions,
millions. So
millions.
yesterday we just had a meeting with Brett Swarts
Yep.
about this because we personally have had trouble with 1031 members trying to get in our funds because they've ran out of time.
Right.
And, at that time, we need to flip that around. And the answer to that is we need to get in front of these operators and educate these operators and these people selling businesses to do the DST. And then the DST can invest in the fund. And it's a
Yeah,
beautiful thing.
absolutely. So for those of you who are kind of just listening in, but don't really know what Eddie kind of is talking about right there, let me break that down a little bit. So when you do it, when you have a piece of property, right, and you liquidate the asset, you can do what's called a 1031 exchange, meaning you can just basically go buy another piece of real estate. Some challenges with that are you have 45 days to identify the properties. You have 180 days to close. You have to go back into real estate. Your depreciation schedule travels with you. If you try to go back into a fund, it's very difficult because it's very paperwork intensive. A lot of times you run out of time, and a lot of times the syndicators or the funds, they don't have the it's not worth it for them, right? If you got $12 million, okay, they'll figure it out most of the time. But a lot of times the challenge is that it just doesn't make any sense. So a lot
It's the
of
time restraint too. I
it's a lot
mean,
of it. Yeah. You
yeah, I
don't
mean,
have enough
it's just
time.
can't get it done.
And so one of the things that we're able to do with the Deferred Sales Trust is we're able to liquidate the asset, and not to mention it could be any asset. It could be a
Right.
stock or bond, mutual, real estate, primary home, crypto, business, whatever, right? And basically, we're able to defer all the tax, and then we're able to reinvest the proceeds, net of attorney fees instead of net of taxes. And that investment is like kind agnostic, unlike a 1031, where you can actually put the proceeds into a variety of different things, including real estate funds. And so now we're at this point to where you've got this pool of money, right? And the win is that you can invest some of it into the stock market, right? We encourage a little bit of that. You can invest a little bit into a business venture or whatever. We encourage some of that. But you can also invest in real estate as a GP or as an LP, a limited partner, or right, and come into these funds. And now you've got this ability to capitalize on the diversified, portfolio of the fund, right, with a good operator, of course, right, like J.E. Austin Extraordinary Capital. You've got the ability to capture some of the depreciation from that, unlike some of the other things. Your depreciation schedule doesn't travel with you like a 1031. And so now you've got this ability to raise capital a lot more than just 50,000, 100,000, whatever, right? We're putting millions in at a time because these people are like, all right, cool. Like I got all this deferred tax, right? My powder's kind of dry. I need to put it somewhere. And when you're earning 10, 12, 15, 20% on some of these, on some of these funds, that's a fantastic return. It's a great diversification from the market. It's a beautiful thing.
It's
And so
diversifying twice.
oh yeah, no, it's changed everything because it
Yeah.
gives it's a win all the
Yeah.
way around.
Yeah.
Everybody wins, like on every single level. And a lot of times we'll get, oh, well, it sounds too good to be true. I would say 97% of the time that statement is true. If it sounds too good to be true, it's probably too good to be true.
Mm-hmm.
I don't know why this one particular thing is true, but it's the 3%.
Right.
And it's a game changer when you understand the power of it and the ability to leverage it. It's 100% Netflix over Blockbuster. What are your
Yeah.
thoughts on that,
100%.
Eddie?
I mean, it's dude. So we went through this again, and I've heard I'm a daily educator. If I can grab your media, that what you guys do at the Capital Gains Tax Solution. So I'm always learning and going through the slides yesterday again. and reiterating, I can't find anything wrong with it. Like, it just makes sense. I don't know why anybody would do a 1031, do a DST. It gives you the diversity of not only being able to invest in a fund without all the headache, without the big time restraints, and then you can sprinkle other capital into stocks and bonds if you wanted to. You
Sure.
could invest it in other opportunities, VCs. You could do so many things with it. And the way it pays you back is just, it's incredible. And then you can even go, not to get in the weeds, but you can do DST 2.0.
Yeah.
I mean, it's just, yeah, we could really get into it here, but I mean, it's just incredible.
Yeah, we didn't even touch on the 2.0. The 2.0 honestly is the absolute game changer for the high net worth people, because in one foul swoop we can move hundreds of millions of dollars outside of the taxable estate and eliminate the 40%
Right.
in
Yeah,
the 40%
absolutely.
death tax, which is unheard of. You know, when
Right.
we start telling like the estate planning attorneys, the humble ones, of course,
Right.
the ones who know everything, right? They're hard to talk to, but that's just that's a whole nother issue. But
So, to do some clarification here. So we did the bottom line here shows J.E. Austin Extraordinary Capital. That J.E. Austin Extraordinary Capital is our new coaching program that teaches the syndicator and gives people the ability to go from a syndicator to a fund manager. And also, it gives you the ability to learn about these different things, and we can help you. And we've recently just reiterated again to open this up now as a real estate coaching program and not just a real estate fund coaching program. So we can actually take the everyday person and teach them these things and give them the ability to be able to do syndication, a real estate fund, wholesaling, the whole 9 yards. Now, I'm a fund manager. We're in between real estate funds at this time, unfortunately, but I also am the VP of Investor Relations and partnered with Hampshire Capital. That's hampshire.capital is the website. And we just are in the middle of getting ready to launch a $50 million 506c fund for the purpose of purchasing large multifamily real estate, North Carolina, South Carolina, Florida, and Texas, and $50 to $70 million buy box, 300 to 600 units at a time, Class C to Class A, all value add. JE Capital is the first company that was founded under us, and that is going to be launching a new fund as a private equity fund, $100 million in size, and we're still working out the details. So you can find that at JE Capital on Facebook or on our website, jecapitalinv.com.
Right on. Awesome. Okay, so Eddie, we are kind of coming up on our time here, bud. But for those of you who want to learn more about the Deferred Sales Trust and building a tax-deferred exit strategy, if what we said resonated with you guys at all, go to capitalgainstaxsolutions.com. You can learn more about the Deferred Sales Trust there. Obviously, keep watching our YouTube videos and our podcast. Hit the like button, subscribe button, notification bell, leave a comment, share with your friends, do all the interweb things that the cool kids are doing now. And we also have a mastermind every Friday, 10 a.m. Pacific, 1 p.m. Eastern, that you can come to sign up for at the website, capitalgainstaxsolutions.com. You can also get a copy of the free DST ebook at capitalgainstaxsolutions.com. So if you've got an exit coming up and you're worried about the capital gains tax, give us a shout. We will help you. We have tons of awesome friends like Eddie who have amazing deals that we bring all the time. We save millions of dollars in taxes, and we help you reinvest so you create generational wealth and freedom from the capital gains tax jail, the 1031 tax jail, the IRS jail. We got the keys, baby. We got the gospel too, if you want that.
Oh man, just to reiterate what he just said, I'm telling you, it would be in your absolute duty to not pay your taxes legally.
Amen.
And get a hold of Brett and Pierce at Capital Gains Tax Solutions, because I'm telling you, when you go through the slides and learn about it, the things that you can do legally, you're not illegally removing taxes. No. You're able to kick the can down the road through this system. It is truly amazing. You've got to go check it out. Watch their media.
Appreciate that, Eddie. Okay, where can people find you? I got extraordinary.capital for your coaching program.
So all of my social media is either Eddie Austin. So Facebook's Eddie Austin, LinkedIn is Eddie Austin. On Twitter, it's Eddie Austin BEX, which for me is Be Extraordinary. And Instagram is Eddie Austin BEX. You can find me on YouTube, Eddie Austin.
Awesome. All right, guys. So go find Eddie Austin on the interwebs over there. And go hit the like button, subscribe button, notification bell on Eddie's stuff too, because he's got good stuff.
Oh, man. Thank you so much. We need that.
So, yeah, we really appreciate you guys. Eddie, any final parting words? Maybe end with the best piece of advice you've ever been given.
The best piece of advice, man, I got to say the best piece of advice, honestly, is just this. Being in a place to where you're having struggles, not having enough money, is just a lack of education. It's not a circumstance. Get out here and learn more. Learn what's going on right here. Go to the Capital Gains Tax Solutions. Learn about investing in real estate through J.E. Austin Extraordinary Capital. All this stuff is learned for free. Read the financial books and just gain the knowledge to up your income and get out of where you're at.
Yeah, love it, man. Absolutely love it. Well, thanks again, brother, for coming back on.
Absolutely, anytime.
We've been trying to get this for a minute now, so I'm glad we finally made it happen. And I'm sure the people learned a lot today about the differences between syndication and real estate funds. Big distinction. So, thank you for the wisdom and the knowledge you dropping over here, buddy.
Yeah, man. It goes hand in hand because you guys teach us, and then we teach our crowd together.
Absolutely. Cool.
You have a great day.
Thanks again, everybody, for listening to another episode of the Capital Gains Tax Solutions podcast. As always, we believe high net worth individuals and the professional team struggle to find great capital gains tax deferral options. Not having the plan is the enemy. So get educated, get a plan. Go check us out. Extraordinary.capital, Eddie Austin on all the interwebs, capitalgainstaxsolutions.com. Thank you guys for hitting the like button, subscribe button, notification bell. Really helps us out. We love you guys, and we'll see you on the next one. Bye now.
Be extraordinary, buddy.